Hey everyone, and welcome. With all the noise and chaos in the markets, how do you even begin to make decisions with any real confidence? Well, today we're diving into a powerful, time-tested strategy that does exactly that. Trend trading. It's all about building a system, a set of rules, to help you ride the market's momentum. And honestly, it might just change the way you look at a chart forever.
The legendary investor Peter Lynch absolutely nailed the trader's paradox with this quote. We're all caught in this constant battle, right? There's the fear of losing everything in a crash, but then there's that nagging fear of missing out on the next huge bull run. And this emotional tug-of-war, it usually leads to paralysis, just doing nothing, which, as Lynch points out, can often be the most expensive mistake of all.
So here's what we're going to cover. First, we'll really unpack that trader's dilemma. Then we'll get into the philosophy of trend following itself. After that, we'll get super practical with how to spot and confirm a breakout. And of course, how to manage your trade once you're in. And finally, we'll look at the incredible reason why this whole strategy has worked for so long.
Okay, let's kick things off with the single biggest hurdle for pretty much any trader, our own emotions. It's almost never the charts or the news that gets us. It's that battle raging in our heads between fear and hope.
And here's the trap. Both sides of that emotional coin can lead you to the exact same bad place. Fear keeps you glued to the sidelines, right? You're waiting for that perfect moment to get in that, spoiler alert, never actually comes. But then hope is just as dangerous. It makes you hold on to a losing trade way too long, just praying it'll turn around. Both are a recipe for disaster. The only way out is to replace those feelings with a system.
And that leads us right to the solution, the trend-following philosophy. Now, this isn't about predicting the future or looking into a crystal ball, not at all. It's about building a disciplined, objective system that simply reacts to what the market is doing right now, not what we hope it's going to do.
And here's the most important part. Price is the only truth. Think about it. The price already has all the news, all the expert opinions, all the fear, and all the hope baked right into it. So if we focus only on price, we can cut through all that noise and build a strategy based on rules, not on gut feelings.
And this isn't just some abstract theory. Look at the incredible story of the turtle traders. Back in 1983, a famous trader named Richard Dennis made a bet that trading wasn't some innate gift. It was a skill you could teach. So he found a group of total novices, people with zero experience, taught them a complete trend-following system in just 2 weeks, and then handed them his own money. The result? 5 years later, they'd made over $175 million. It was proof positive that a rules-based system works.
And these were the rules that drove their success. They're simple, but they are so powerful. Focus on price, not opinions. Buy strength, sell weakness. But most importantly, and this is key, manage your risk like your life depends on it. Notice how many of these rules are about playing defense. Plan your exit, know your loss limit, control your size. That's what separates the pros from the amateurs.
Okay, so the philosophy makes sense, but how do we actually put this into action? Well, it all starts with spotting that moment when the market's behavior might be changing. And for us, that signal is the breakout.
A breakout is basically our green light. An uptrend is just a series of higher highs and higher lows. A breakout is that moment the price punches decisively through a previous high, signaling that the bulls are back in control and the upward move has a real shot at continuing. It's the market breaking free.
Now, to make this really concrete, let's look at a classic pattern, the cup and handle. It's just a perfect visual for this entire idea. First, you get the cup, which is this gradual basing period. Then you get the handle, a little dip that shakes out all the impatient traders. The top of that cup creates a line of resistance, we call it the neckline. And our signal, it's when the price finally breaks out above that neckline with authority.
And now we get to the million-dollar question, because not every breakout is the real deal. In fact, a lot of them are what we call false breakouts, or fakeouts, and they're designed to trap traders who jump the gun. So how in the world do we tell the difference between a real opportunity and a trap?
Honestly, getting this right is one of the most important skills you can learn. It will dramatically improve your odds. And the good news is, the clues are always there if you just know what to look for.
This table lays it all out pretty clearly, but let's focus on the two most important clues here: volume and what we call retest behavior. A true breakout almost always happens on a big surge in volume. It shows conviction. A fake one? The volume is usually weak or even declining. And the other big tell is that a true breakout will often come back down to retest that old resistance level, and it will hold as new support. A fake out will just slice right back down through it.
Let's just double down on volume for a second. Why is it so critical?
Well, a huge spike in volume, we're talking 50% or more above the average, that's your sign that the big money, the institutions, are jumping in. This isn't just a bunch of small traders getting excited. This is serious capital getting behind a move, and that gives the new trend a much, much higher chance of actually going somewhere.
And that brings us to what I like to call the patient trader's secret weapon, the retest. So instead of panic buying the second the price pops over the line, you wait. You let it pull back to that breakout level. If it touches that level and bounces off, confirming that the old ceiling is now the new floor, that is your high probability entry point. Yeah, it takes discipline, but man, it saves you from so many fakeouts.
Okay, so we've found a trend, we've spotted a confirmed breakout, and we're in the trade. Now what? The job isn't done. This next part is where the real discipline kicks in, managing the trade from start to finish.
Think of it as a simple three-step process. 1. Your entry is based on confirmation, not hope. 2. And this is absolutely non-negotiable. You define exactly where you'll get out if you're wrong. Your stop loss is your safety net. You have to have it. And 3, you decide how much to trade based on the market's current volatility, not on a gut feeling.
So how do we set that stop loss objectively? One of the best tools out there is the average true range, or ATR. It's just a simple indicator that measures volatility, basically how much a stock tends to move around on an average day. Using the ATR takes all the guesswork out of where to put your stop. You're basing it on the market's actual behavior, not some random percentage.
And what's so great about it is how flexible it is. You know, a short-term day trader might use a really tight stop, maybe 1.5 to 2 times the ATR. But a longer-term position trader, they need to give the trend more room to breathe, so they might use a multiple of 3 or even 4. It makes your risk management dynamic and perfectly tailored to your own strategy.
All right, you're probably thinking, this all sounds good, but does this stuff actually last? Is it reliable? And that is a totally fair question. So let's zoom way, way out and look at the history, because the fact that trends persist is one of the most well-documented facts in all of finance.
Yeah, that number on your screen is not a typo. We're talking about academic studies that have combed through more than 200 years of market data. And they found that trends are a real, persistent, statistically significant feature across everything: stocks, bonds, currencies, you name it. This isn't some flash in the pan. It seems to be a fundamental part of how markets work, probably because it's driven by timeless human psychology.
And that really brings us to the ultimate takeaway here. Look, the goal of a trend-following system isn't to be right every single time. You're going to have a lot of small manageable losses, and that's okay. The real goal is to have a system that makes sure you're on board for those big, powerful, game-changing trends, while your risk management plan protects you from the kind of catastrophic loss that can wipe you out. It's about staying in the game.
So, we know that trends have been a feature of the markets for literally centuries. They're not going anywhere. The only real question left is, what's your plan to ride them? How are you going to build a disciplined system that replaces that fear and hope with rules and puts the odds back in your favor? Thanks for joining me today.